Everybody's always asking, hey, where's the best market? How's the market? Is it going to make me money? Blah, 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 blah. We're always talking about the best markets, but let's talk about the best markets that will actually make you money in 2025. It's not what you think. What if I told you the most profitable Airbnbs in 2025 is not New York, Miami, LA? It's just not. It's not in some trendy influencer overrun hotspot. It's in a place you'd probably drive past and not even give it a second look. It's in the sleepy towns where people are quietly making millions of dollars and you didn't even know it. And investing in these hidden markets is easier, cheaper, and more profitable than anywhere else. But the clock's ticking. Once the word spreads, everybody's getting after it because it's a gold rush. Of course, everybody wants to run where there's gold. And if you were the last one there, you're gonna miss out. You don't want to be the guy that's left competing for the scraps. You want to get the big gold bars, maybe even the gold nuggets, but not the gold scraps. So today, I'm going to show you how to find these markets before anyone else does, and why working with us makes the most practical sense and is essentially foolproof. You might be wondering, who is this guy and why should I care? Fair question. My name's Matt, and I turned $30,000 in real estate investing into a $10 million short-term rental portfolio that is now generating 7 figures of income for us. And better yet, we did this by investing in the small, no-name towns nobody really pays attention to. And no, I'm not from out of nowhere. I've been doing real estate for over 12 years, and all the million-dollar problems I've had are lessons that you get to earn for free. Lastly, we have buyer clients and also coaching members that have been buying Airbnbs, and we're very excited for all the wins that they've been having, and we're hoping that you have those same experiences. We sold over 200 of these types of investment properties, and I'm sure we can find you one as well. So let's answer a couple questions. Why are the traditional markets failing? Let's be real. Airbnb gold rushes in the big cities, they're dead. It's over. Have the funeral, move on. Let's talk about why. Properties are getting so expensive in some of these saturated towns, they're starting to cost you an arm, a leg, maybe even a soul. Keeping it simple, most places in these high demand towns will cost you $1 million for a shoebox. I mean, if you're going to invest in LA, a shoebox at $1 million is not going to cash flow. That's the real reason it's dead. And the competition is brutal. There are so many super experienced hosts out there with exceptional properties that continue to develop their property year after year to make sure they remain the top competitors. And if you aren't prepared to play at that level, you have no business even trying. You will lose and it will suck because the 20 others that have already established it and they have no reason to give up, you're not going to compete with them. Plus, what else? We've seen the cities are cracking down. That's right, regulations are getting really strict, especially like Chicago, San Francisco. These places have cracked down and it's gotten really brutal to try to operate. In fact, New York did a full ban and now they're going, hey, you know what? This ban didn't really help us, but do you think that created more confidence in those investors that still try to get through that tough time of that shutdown? No, they were like, I don't even know if it's worth still going. And maybe some people came back to it. But it's a tough call right now when you're working with super adverse situations that are usually brought on by heavy density of angry neighbors. Meanwhile, in the quieter markets, there's other investors that are making plenty of money and they're buying at a fraction of the price that most of these big markets are paying for. Right now, we have a client that's under contract and about to close next week. He normally invests in Seattle and almost everything out there costs him about $1 million and it makes about $100,000 in gross income, which really doesn't provide a whole lot of benefit. But guess what? We found a property for $500,000 that should do about $120,000 here in Michigan. I'm just gonna tell you, the ratio looks way better that way. If you can pay half the price and get almost the exact same gross cash income, it's a really big win. Plus, when you're investing in these top-end established markets, 2 things are already established: the top value of the property and probably the ceiling of the cash potential of that property, meaning how much money it can actually make. But if you invest in the up-and-coming areas, you don't know what that ceiling is. In fact, you still have room to grow and create and find that ceiling, which gives it a lot more potential. And on top of that, if it's an emerging market, there's still room to grow even on the property value. So automatically you're getting more runway on your property value, you're getting more runway on the potential income, and you're usually paying a fraction of the price for almost the same gross income, which makes it a way more intelligent decision. So what's the secret? Invest in the secondary and tertiary markets, in the markets that they don't have any data. I don't see why I would invest in that. I know it sounds crazy because what are we constantly hearing? Invest where there is data, because that's what a sound, intelligent decision would be. You're right, it would be. But sometimes what data also shows us is what the average would be, or what people that haven't even tried have done. So if you're going to bring something exceptional to the forefront of these secondary and these tertiary markets, or these markets that haven't even been established, you're going to create revenue that is truly off the charts. And better yet, we've been doing it for the last 4 years. We've created revenue that has been record setting in city after city that we operate in because we know how to bring an exceptional property to life. We know how to design it better, manage it better. And because we're doing that, we're setting new records. And what's funny is most of the data on our properties, when you look at AirDNA or anywhere else, it shows sometimes as much as 80% less than what we're actually profiting. So the data you're pulling is either delayed, delinquent, or just plain faulty. I don't know how else to put it. That's why you have to be very careful with the data you're researching. It is showing that I am in those markets, but it's not showing how much we're actually making. So think about that. If on average, all the data you're looking at was actually 20%, maybe even 50% higher than what you're actually pulling, you're probably missing something, right? That's a lot of money that you're leaving on the table and you're not capitalizing on, and you should be. So how do you be in these markets that are on the verge of exploding? Think like this: small towns near major cities. Picture cute coffee shops and a farmer's market every Saturday. Lake and mountain retreats where people pay premiums to disconnect from their phone, but they make sure they still post it on Instagram. College towns where really studious 18 to 24-year-olds go to get a better education and party. And what happens after that? The steady flow of alumni and parents that come to visit or celebrate graduation. And especially if it's a big football team, the football fans, they are coming. Go Blue! How about a couple more? The growing suburbs outside of the metro city. Bonus points. If there's a Costco there, you're probably going to be fine. Any of the big market food and supply chain stores that you might see are usually a sign of enough life for that big business to say, hey, we should operate here. People are going to come here, and if it's staying in business, that's proof that it worked. And later on in the video, I'm going to give a few more pointers on how to actually source and find these properties. So stay tuned. These types of markets are going to give you lower costs, fewer headaches, and higher profits. Smart investors know it, and now so do you. So definitely take some action. I want to share a case study with you, something that actually kind of even shocked me because I was surprised it worked. Let's talk about Austin and Michaela. I had this couple join our mastermind, and when they told me about their 2-bedroom property on the lake, I thought, that's pretty remote, and it's a cool house. It's got a great view, but I can't imagine it does more than 60,000. Man, I was wrong. Just a couple of regular folks who decided to take a chance on a lakefront property here in Michigan. They bought it for $215,000 and they put $40,000 into it after the fact. Just upgrades and things to make it rental ready. In their first year, they brought in $76,000 and now they're trending toward $90,000. So in this market of Airbnb bust and everything's getting worse and there's no good deals out there, and the properties that we are looking for and the things that we are improving on our properties, we're actually seeing things ticking up. And just like most markets, the summer market is the hottest for money and weather. And with that, they made over $37,000 in their first summer season. That's that hang out on a dock and drink margaritas money. Like, way to go, babe. Same to you, honey. That's the kind of conversations you want to be having. And what did this help them to do? It helped them dream and explore as entrepreneurs, as real estate investors, and better yet, they simply love their property. So they still get to use it and they're still making great money on this. That's living the dream, man. And guess what? Now that they've established that, now that they're working with our mastermind, they're seeing that, wait, the sky's the limit. I can do so much more. So they're working on buying their second one right now. And what's the key? They got in before anyone else established a quality property near them. And better yet, they believed in something. And they said, hey, not only do I believe in it, I want to use it. And because they do that, they put so much more love and energy into this property. And that's exactly why they are having exceptional results. But here's the thing, these opportunities don't stay a secret forever. Prices rise and competition will show up. Luckily, there are still hundreds of markets out there that are still very much untapped and unsaturated. And I'm going to show you how to find them. Real estate isn't about vibes or luck. It's about trends, timing, and data. But luckily with what we do, there's also hospitality. And vibes do matter when it comes to hospitality and creating exceptional stays. Step 1, we still need to analyze the data. Here's why. Preferably, I like AirDNA right now. There's a couple other things coming out that I want you to keep a lookout for, but look for occupancy rates above 70%. In terms of tools out there that help you find out what type of properties are making money, here's 4 that a lot of people use. AirDNA, STR Insights, B&B Calc, and STRIQ. I like all of them for different reasons, but let's just stick with AirDNA for right now because most everybody knows about that one. When I'm looking at these properties, I'm trying to match up what my property would or wouldn't be. If I'm looking at 4 bedrooms, 2 bathrooms, I'm going to try to focus on what types of income earnings you see on those types of properties. However, when you're looking for those, especially in emerging markets, you got to understand you probably won't see a lot of those, especially if you're going to buy a 5-bedroom, 3-bathroom. And here's why. The bulk of investors start with safe and small. So they'll look for the 3-bed, maybe even the 2-bed that only has 1 or 2 bathrooms. Very basic, simple houses, a quick little cottage on the lake, something easy that doesn't break the bank. Most investors are actually afraid to do something very exceptional because the data doesn't show it. But let me ask you, if you see a few of these 3-bedroom properties on the lake that are making between 40 and 70,000, and they all have bad cleaning, bad management, bad design, and they're smaller than what you could potentially buy, is it possible that $40,000 to $60,000 range becomes the floor? That's what I believe, and that's exactly how I work. Look for properties that can set the base value, the floor, of where you can build a property that's going to be exceptional above and beyond that average. It is also good to pay attention to occupancy because sometimes you start noticing that year over year occupancy and rates are trending downwards. Now that could be because more and more average or basic properties are emerging or becoming delisted. So whatever it is, pay attention to it because it will be helpful to understand in terms of how you go about investing intelligently. Step 2, Burger King. What does Burger King do? It just waits for McDonald's to get established and then it moves across the street. And that's kind of what we do sometimes. We'll look for something that's well established, that's going to be successful, like a McDonald's. A really great property or hotel gets established in an area. And maybe we invest right down the street with something that's a little bit different, a little bit tastier. Maybe we have the curly fries, whatever it is. Something that's going to be fun and different, but we're going to let somebody else take that risk sometimes. And better yet, can you imagine with all the cities that are getting banned? Rather than staying directly in that city, what if you stayed just on the outskirts of that town? For instance, in Ann Arbor, Michigan, there's a lot of Ann Arbor that is banned. The map zoning does not allow you to be in most of the inside portion of Ann Arbor. But just outside of all the freeways and just on the outskirts of into other towns, those secondary markets, guess what's available? Properties in areas that are not banned. And a lot of people that want to visit Ann Arbor know that. And sometimes there's a benefit to being just outside of that town. So sometimes the Burger King method even applies to being one town over. So if you're ever in a town that's banned, that could be good for you. So at that point, you're going to want to consider stepping just outside that line. Could put you in a place that's quite fine. So step 3, tourism and growth. It does matter. It's not the thing that I really anchor all my decision making on, but I think it's valuable. My thought here is this. When you see that there's growth in a market, maybe they're building out the airport, maybe they're expanding something, they're adding more stores like Costco or other big department stores, malls, always look at the city planning site. It's going to give you a lot of information on where that town is heading. Because if it's a small town, but it's getting bigger, it's a really good sign that there must be job growth here. And what happens when there's job growth? There's population growth, there's economic growth. And those are the things that are going to drive more money to that town, which means you have something that's great kind of as a temporary housing solution, especially when they're trying to see, hey, do I want to live here? Where do I want to buy? That's a great place to be. So think about that. Plus, the other benefit of that is for the real estate. If the market is continuing to increase in population and density and economic growth, the home values are also going to rise. So at that point, you're really making an investment in the area that's actually going to grow with you. It's just parking your money rather than in a bank. It's in the real estate. There's so many reasons to do this. And again, a lot of people get caught up in real estate thinking, oh, it's just the cash flow. It's never just the cash flow, and it shouldn't be. It's the taxes that you can save, and it's the appreciation. And trust me, it is the number one thing I always have overlooked. And let me tell you, after 10 years of owning real estate, when you see that you're making $100,000 in equity growth on each of your properties and you've built a large portfolio, trust me, it starts to add up in a big way, and you want that. Oh, you really want that. Step 4 is avoidance. Avoidance is kind of what I've been hitting on. It's not the typical kind of avoidance. It's dodging the things that people are telling you are home runs. I pick on this market a lot, but I'm going to do it again. Orlando, the Smokies, they're so established. We talked about picking places that already have a floor. A floor is something we know, okay, we can at least hit this mark if we're mediocre, but they don't have ceilings. But the places that have ceilings where you're like, there's no way I can get past this number. And let's say you see 1,000 Airbnb listings in that same city, it's probably not where you should be investing. it's not like the income's going to probably go up from there. It's probably going to go down in the next 5 years. And the thing about step 4 is avoiding the fact that you might get stuck in a market that's going to be depreciating for the next 3 to 5 years. You want to avoid those like the plague, because God forbid you buy that property and in your first year, all you're seeing is a downward trend of income and appreciation of value, meaning you're completely losing every dollar you put into this. You don't want that. You want a place that has no ceiling on income and no ceiling on the appreciation of the real estate asset. Whatever you invest in, you want to make sure you never are starting with a runway that's already been cut off. Think about it. You think you're going to launch an airplane on a 15-foot runway? Not a chance. You got to make sure that thing is at least 1,000 feet. And if you don't do that, you could end up in that short runway where you're going to be really fighting against everybody, just trying to stay alive and maybe just crashing and burning before you even take off. And I don't want that for you. Okay, so we just went through 4 key points that will get you probably to 80% success rate on your next Airbnb purchase. I really think you're going to be happy with those, especially if you implement them. And of course, I want nothing but success for anybody that works with me or our team. But let's say you want to go a little bit deeper with our team and you're looking to see, hey, how does Matt teach? We actually have a free mini course in our description that you can check out. All you got to do is go jump in there, click it, get at it. You'll get the access. You'll see some of the other concepts that we're teaching about money mindset, investing, you name it. And from there, you're going to go, okay, I either like this guy or maybe I need to schedule a call and talk to him a little bit more in depth and see, is this a good match? Is there a good connection with us in the coaching system for you? And we're happy to explore that. So if you want to, just check out that link in description and we can go from there. Listen, I'm not just a coach either. I'm still an investor. I'm a real estate broker. I'm a mortgage broker. I've been doing real estate for over 12 years and I freaking love it. I'm not going anywhere. From my careers in both corporate America, getting my W-2 and then switching to becoming an entrepreneur, I've learned how to do underwriting of all types of deals, doing valuations from appraisals, as well as income generating approaches on all types of properties. We can help you negotiate contracts. We can help you get the financing on your deal. There's really nothing we can't do. Plus, we have an in-house setup and design team that actually helps you get going if you don't know how to design or you're just terrible at it. And worst case, if you can't even manage your own property, we can manage it for you. We've got a 4.9 average across all of our properties, and we have over 2,500 reviews at this point. So we've got plenty of experience we're happy to share with you. And even better yet, for all of our mastermind members, we actually have exclusive pricing and options for them to set up their properties, get them designed by us professionally, and also get them managed. Because it can be really hard to learn all this at once, and sometimes you might need a hand. So if you do, we have specialty pricing set up for them exclusively, because sometimes it's a lot to take on this adventure of investing in real estate and becoming an entrepreneur at the same time. And having a little help from a trusted source is a game changer. Now I want to talk to you about 3 nightmares you got to avoid when you're getting into Airbnbs. Number 1 mistake is ignoring local laws. Sounds obvious, but it still happens, which is kind of insane to me. Don't be the person who buys a property just to find out it's getting banned in your city the following month. Yes, it has happened. Ask me how I know. How do you avoid it? Call the zoning office and ask about current and future regulations regarding short-term rentals. It can be that simple. If they don't answer, send an email. If nothing else, send the email because you want to get it in writing. Focus on Airbnb-friendly areas that actually like the business of short-term rentals and tourism coming in. Typically, they're going to be more open to it than other towns. And last but not least, talk with the agent. Whoever's representing you, whoever the listing agent is, ask them directly. Do not dodge the question. Say, hey, we are looking to do short-term rentals. Is there any known issues or things coming down the pipeline, any issues with the neighbor that I need to be aware of before I engage in buying this property? Stop talking. Just listen after that, because this is their opportunity to come clean on things that may be necessary to disclose. By the way, we just released a video on 2025 regulations and how to make sure you don't get burned. Make sure you check that out. We go down that rabbit hole of all the things you should and should not do to make sure you are successful and not burned. I think it'll be very helpful. Check it out. Give me a like, follow, and subscribe if this video hasn't earned it yet. And if you watch that next video and it earns it there, I'll take it there. Again, the link is in the description. The number 2 biggest mistake, underestimating seasonality. Now, the truth is, just like in that case study I was sharing with you, sometimes 40 to 60% of your entire yearly income can be earned in just the summer. Let that sink in. Let's call it 50%. That means the other 50% is scattered around 9 months. So if you look at it like that, you got to know that it's kind of feast or famine in moments. If you don't understand that you have an annualized average that you need to consider in your underwriting versus how that cash flow will pan out when you're in the dead season, let's say in January, February, which is traditionally one of the worst times annually for most properties, unless you're in a ski or snow zone, then it's okay. But if you're not, if you're a lakefront market that has no skiing, no snowboarding, it's going to hurt you during that period. And you want to make sure you're prepared for that. Now, there are other amenities and location factors that can offset that and sometimes even bring you more money in the winter. But if you don't understand that seasonality, it can hurt your cash flow. And if you're not prepared with reserve cash on hand, you might end up losing your house. And we don't want that for you either. Last piece on seasonality. When you buy the property can be a big factor. One benefit of buying a property in the winter is typically prices are a little depressed. They're a little bit lower. So usually you can get a better deal. And on the other side of that, if you're buying in the summer, you're buying at the high end of home values, but also the high end of income earnings. Meaning, as you get that property up and running in the next couple months, you're probably losing your best capital earning opportunities right then, but you also paid the most for it. So there's pros and cons to that. Usually you have more properties on market during that period or just after July 4th, after people have finally enjoyed their homes for the last time that they're going to enjoy it. For summer, they go, you know what? I've had my enjoyment of this property. I'm going to sell it and let somebody else take on this legacy. That's the way people sometimes think when they're selling their lakefront homes. So you're going to get it at the end of the peak season of summer. And by the time you're launched, maybe in late summer, early fall, you're going to see a decline in income, which will be very scary if you're not used to that or expecting it. So how do you avoid it? Check AirDNA, see that graph, see where the highs and lows are, so at least you can expect what's to come. And number two, choose markets with multiple demand drivers. I try to pick markets that have at least 3 seasons of demand, meaning I want something that's going to hit in the spring. I want something that's going to hit in the summer and the fall. The winter's kind of hit or miss no matter where you're at. Now, if you are on a snow mountain, that could be great. But what happens when there's no snow and you only picked a market that had winter as the key market? That could really hurt you. Mistake number 3. It kind of goes against what I've been saying, but it's good to know because you need to balance out all thoughts and ideals, right? Assuming all cheap markets will boom. Cheap property doesn't always equal good investment. If there's no demand, you're stuck. Now, a lot of the times we think of demand as, oh, what are the demand driving factors around it? But there's one caveat too. Sometimes the property is the demanding driving factor because it's so special or can accommodate things that others can't. Maybe it's the only 10-bedroom, 8-bathroom house in the entire state. That would be a reason why it might get picked over anything else. Maybe it has an indoor pool, or maybe it has tons of lawn area for setting up its own wedding event or some kind of corporate retreat. That's a situation where the property on its own becomes the driving force. And that's a really special type that we actually do try to focus on and teach. One more caveat. Sometimes people are so busy trying to buy that property under $250,000, which can work, but sometimes it's such a small property with other caveats and oddities that will actually lead to inhibited income anyway. Sometimes it's such a small town. If it's selling for $100,000 right now, you should probably think 30 times over before you buy that property. There's got to be some reason why a property is that cheap and probably won't do well. Adversely, if you're in a dense population area and it's just a really ugly property and needs a massive fix, and it's a property that could be rehabbed, a burr, and you can rent it and refi it after, then there could be some sense to be made of that. But the best way to avoid this mistake is simply make sure you're checking demand if your property can't be a demand driving factor. And if that property is not adjacent to a great market or it doesn't have the possibility of being rehabbed into an excellent property, you probably should walk away because there's a reason those $200,000 properties on the lakes are still sitting. Either they're in a flood zone, maybe they've already started dilapidating, maybe the lake is nasty. There's so many different reasons why that could be the case. Just pay attention to those things when you're doing your underwrite and you'll probably be fine. The best Airbnb investments are not in the places you typically expect. They're in the hidden markets, the one-off cities, the little sleepy towns that people aren't paying attention to. They are affordable now, but they won't stay like that forever. So definitely, if you see something you're pretty interested in, take action. And if you're not sure if it's the right move, but you're on the fence about making that big decision, you can also reach out to us and we can set up a call to do a one-on-one consult. And additionally, you can join a group of people that are doing exactly what you want to do and being successful at it. Join the mastermind. So are you going to act now or are you going to let everyone else keep beating you? I don't know about you guys, but I was the same way. When I was in corporate America making $260,000 a year, I was still letting all these opportunities pass me by. I could have been retired so much earlier. I could have been a multimillionaire so much earlier, but I was so busy letting all these things and fears get in my way. So if it's fear or there's something that's just holding you back and you think it's kind of silly or doesn't really make sense, have that conversation with yourself. I won't think you're crazy, or have it with us. And we can at least figure out what it is to get you moving and actually doing the things that you've been wanting to do. Because what you're really doing is you're denying yourself from a greater life right now by not taking action. And that is one of the saddest things we can do. And it's 2025. I know you have new goals. I know you want to make something of yourself. So do it. So keeping it conversational, drop a comment about what's holding you back. Drop a comment about what was helpful in this video. Maybe even just tell me what kind of markets you're looking into. I'd love to discuss those things. I will always respond to you because that's what I do. Even if you're a troll and you just need some love and you need somebody to give you some energy for the day, I'll do that. You might make fun of my hair or say my video is stupid, but I'm here for you, buddy. I'll give you a digital hug. And don't forget to like, subscribe, and share. Really helps us. And stay tuned for the next video. We're going to really try to keep bringing a ton of value to you guys. Hope you appreciate it. Stay tuned.